Welcome back to your go-to show for unlocking financial freedom through the power of commercial real estate investing. Today, we're diving into a topic that stops most aspiring investors dead in their tracks, and that is how to buy multifamily property with no job or no income. Sounds impossible, right? But here's the truth, it's not. So whether you are starting from scratch, you can't scale fast enough with your single family home investing, or you've been laid off from your job, or you're in between jobs and you have no income, or how about this? Peter, I'm done with my 9 to 5, right? I'm not going back. How do I get a loan to do this full time, right? I love this quote from Eleanor Roosevelt. She says, never allow a person to tell you no who doesn't have the power to say yes. Got it? So if you ever thought this, I can't invest because I don't have a job or steady income, I want you to think again. It is possible. In today's video, I'm going to share with you the possibilities. Let's get started. Click subscribe and add alerts so you can get more easy to understand commercial and multifamily wisdom. Real quick, what I wanted to do here is share with you first what inspired me to do this video. I get the awesome privilege of mentoring aspiring real estate investors all across the country who started with nothing. And we taught them how to become successful commercial real estate investors and change their financial lives. So I'm going to start off this video with a question, okay? I'm going to go over 5 quick scenarios and I'm going to ask, is this you? And if you can identify with one of these 5, I want you to put in the comments which one you are, okay? Because it's all about us helping you. All right, so is this you? Which one is you? All right, you own single family rentals, but you're stuck, right? You see that financial freedom is not possible because your single family rentals has only taken you so far. You can't retire from your job. You can't cut down hours, or your single family rentals do not produce enough cash flow. Is that you? All right, how about number 2? You've been laid off, okay? Or you are in between jobs and you would like to you want to buy commercial or multifamily property, but you have no W-2, okay? Is that you? All right, how about this? Your personal DTI, your debt to income ratio, when you go get a loan, the bank's gonna look at your debt to your income ratio, and your income ratio, your income needs to be higher than your debt, right? But let's say your personal DTI is too high and the bank loan is not possible. Is that you, right? And you want to continue to buy multifamily? Let me know in the comment box if this is you. And number 4, you're done with your 9 to 5. You've been laid off or you quit and you say, Peter, I am not going back. I am going to do multifamily commercial full-time. This will be my full-time job. But how do I get a loan? Okay, if that's you, put it in the comment box. Or if you want that to be you, put that in the comment box. All right, and lastly, is this you? You're done with making excuses. It's time to improve your financial life. It's time to get it done. You're not getting any younger, and it's time to do it now. If that's you, put this in the comment box. I would like to hear from you. It's all about helping you. All right, so next, what I'm going to do now is share with you the 2 strategies that will directly help you overcome these obstacles. Here are the 2 strategies that will help you get across the finish line. All right, strategy number 1 is called a non-QM multifamily loan. A non-QM, QM means qualified mortgage. So this bank loan is not a qualified mortgage, meaning it's designed for credit-worthy borrowers who don't fit into the standard or conventional lending requirements, okay? For example, you will not find these loans at a JP Morgan Chase, Bank of America, or Wells Fargo. You won't, okay? So what we're going to do is we're going to use a DSCR loan designed for multifamily 4 to 50 units. DSCR is debt service coverage ratio. So what it means basically is this: the loan approval is income dependent mainly, all right? So this loan is designed to be approved based upon the property's income. And a complete example will follow. All right. So that's strategy number one. Strategy number two is creative financing. And by the way, I think our company is the best at doing creative financing for multifamily commercial in general. So many success stories. Okay. All right. Here in your creative financing, no banks are involved. There's no credit check, and there's a low down payment potential. And I'll give you a great example of what we do here. And the financing is based upon your creativity and basically designed upon the seller motivation. Okay, so once you get the seller motivation, we reverse engineer the deal based upon that seller's motivation. Okay, so also known as seller financing. All right, let's get started with the first one. Okay, the DSCR multifamily loan. All right, here are the features for strategy number one, your DSCR multifamily loan. Number one, there is no W-2 required, no proof of income, no tax returns. Credit score must be 660 and above, okay? If the higher your credit score, the better the loan terms you're gonna get. The lower the interest rate is, and most likely the lower the down payment will be as your credit score goes up, okay? So the more credit worthy you are, the better the DSCR loan you're going to get. Okay, multifamily, 4 to 50 units. The property needs to be somewhat stabilized. No major immediate repairs are allowed on this type of loan. Okay, all right. Max loan up to $5 million. That's great. Down payment 20 to 25%. If you were calculating one today, I would use 25% to be on the safe side. Okay, interest rate because you are getting this loan without W-2 proof of income, there's a price to pay, and that price to pay is a higher interest rate, half point to 1.25 higher than a conventional loan. Okay. All right. Next, this is pretty cool. Um, when you buy a home, you usually get a 30-year fixed rate. In commercial, it's not the case. Okay. So in commercial, we have a 5, 7, or 10-year balloon. Okay. And it's amortized over 30. Sometimes we can get a DSCR loan that's even fixed for 30 years. Okay. Now, the other great thing is there's also an interest only payment option. Because you're paying a higher interest rate to knock down your mortgage payments and make it and force the cash flow, you can do up to 10 years of interest only payments. Pretty cool. Foreign nationals are okay. So if you're not from this country, no problem. You can use these types of loans to buy your multifamily. And lastly, gift money is accepted. So if you don't have all the down payment yourself and you're going to get it from a loved one, you can do that here. Okay. The only requirement for most lenders is the down payment. You put up at least 10% of the down payment. So if your whole down payment is $100,000, you need to put up 10%, $10,000, and your loved one needs to put up the other 90,000. Okay, that's how it works. All right. Now, what's the most important thing here? What is the most important thing here? I'm going to do that next. Have something to share? We'd like to hear about it. Please comment below and we'll respond, including me personally. Here is the most important thing when dealing with a DSCR multifamily loan. It is the property must cash flow a certain level. That is an absolute requirement, okay? The gross rental income, the GRI, must be at least 1.1 to 1.2 times greater than your PITI. Your PITI is your principal and interest, taxes, and insurance. So basically your mortgage payment, taxes, and insurance. Okay, here's a quick math. So your DSCR is equal to your gross rental income divided by your PITI. So if you have a monthly income of $10,000 a month and your PITI is $8,250 a month, you have a ratio of 1.21. Okay, so that is your DSCR. All right, got it. So again, your DSCR, your debt service coverage ratio, is how much does your income cover the mortgage? Okay, that's what that means. Now, just my background with the lenders, if you have on a deal a DSCR less than 1, Some of them will do it. You're not going to get the best terms, but some will do it. You probably need to have other assets covering the negative cash flow. Okay, so sad face here. Now, when you get greater than one, that's when you get a lot more attention from the DSCR lenders. But when you are greater than 1.2, this is ideal for most lenders, and there's a big happy face there. All right, okay, so there you go. Let's move on to a quick example of illustrating how a DSCR multifamily loan works. Got questions? Simply text the word Peter to 833-942-4516 and we'll help you. Before I get started in my example, and this statement covers the entire video, okay, I am using a broad and general description of DSCR terms, and there are dozens of DSCR loans out there, and a lot of them, all the terms are different. Remember, this is non-QM, so they make up their terms. These are private individuals, wealthy companies that make up these loans for you. So there is no default terms for DSCR. So I may mention something here that you never heard of. So it's not wrong or right, it's just a different lender. Got it? All right, let's get started. What I want to do here is share with you how to calculate the DSCR on a loan so you can take your deal and see if it could get possibly approved. Okay? All right. So we have a DSCR deal example. It's an 8-unit at the purchase price is $1 million. The gross rental income, or GRI, is $116,000 per year. Here's the goal. The goal is to calculate the DSCR to be 1.2 or greater. Okay, that's the goal here. Okay, so the mortgage is going to be a $750,000 balance, right? So if I buy it at $1 million and I put down 25%, which is 250,000, that my balance is going to become 750,000. Okay, I'm going to use a 8.5% interest rate, okay, to be on the conservative side, 30-year AM. Okay, the payments are going to be $5,766 per month, or multiplied by 12, it would be $69,192 per year. Okay, so in my calculation, this is the PI. Principal and interest payments are $5,766 or $69,192 per year. Taxes are $12,000. Insurance is $6,400 per year. Okay, here's the calculation again. DSCR is equal to GRI divided by the PITI. So if I have 116,000 divided by this total PITI, the total is 69,000 plus 12,000 plus 6,400, that's 87,592. Do the math, it is 1.32. So thumbs up on this deal. Okay, so our goal was to calculate the DSCR to be greater than 1.2. It's at 1.32. So this deal, you would have a lot of lenders, the multiple DSCR lenders out there with all their different qualifications, they would be interested in this deal. Okay, one thing I want to make a note of that you should too, make a special note here, is if you were to make the interest only payments here, okay, so instead of making principal and interest payments here, if you were to instead make interest only payments, it would increase your cash flow by $5,400 per year. That's huge on an 8-unit, right? That's huge. Okay, so it's great having that option if that's what's needed. All right, great. Okay. Okay, good. So now what I want to do is get on to strategy number 2. Here is strategy number 2. Okay, strategy number 2 is creative financing. And I'm going to cover this in about 10 minutes, but I have a longer video here called Creative Financing Commercial Real Estate. It's about 30 minutes long. It's a great video. It's approaching 50,000 views, and I cover all facets and different strategies for creative financing. So you should watch it. The link will appear on the screen. Okay. All right. Let me get started. Today I'm going to focus on our main strategy, which is the master lease agreement. And I believe we are the best at this and teaching our students how to do it and doing wonderful deals. Right on the screen, On the screen, it appear a picture of our student, Dean. He did a self-storage deal. He bought it. He did a master lease on it with a seller for about $2.5 million. He's close to selling it to close to $4.5 million in about 2 years. So there's no way this property would have qualified, or even him, for this $2 million loan, but the master lease worked in this case. And the same thing applies. We've done this for multifamily over the last 20 years as well. All right. So the master lease agreement, no banks involved, okay? Because it's a lease. You're leasing it from the seller, okay? No credit check for you, and low down payment potential, okay? I will give you an example of what our default strategy is that we teach our students, okay? And it'll include this low down payment potential. Here's my saying, okay? When a motivated seller meets a motivated buyer, that's you, wonderful things can happen, okay? So once you get trained on the seller financing techniques and you discover what the seller's motivations are, you can create great win-win deals, okay? So the most important thing here is to get the seller's motivation, and then we structure the deal around the seller's motivation, okay? I will give you some examples very shortly on when to use it, and you'll see what I'm talking about. Okay, so basically what you do is you're going to give the seller a down payment, okay? And then you're going to get equitable title. You're not getting legal title, you're getting equitable title. Our master lease agreement document is close to 20 pages long, so it's a very strong document. This is not a master lease option. This is not it. This is much more robust than that. This is a master lease agreement. It is for commercial real estate only, okay? You get the full control of the property, meaning that you get all the cash flow. That means you got to pay all the bills, okay? And you get all future equity created. So if you buy a property for $1 million and you raise the rents over the next 5 years and property is worth more, you get all that created equity, okay? All right. And the seller gets a down payment at the beginning. He gets monthly payments on the interest on the balance left over every month. And most importantly, he gets relief from operation for the period of the master lease term. Okay, so this is a win-win for the seller. And then at the end of the master lease term, which is usually about 5 years, okay, you don't have to pay off the balance to the seller. So that's how we end it. Now, what I'm going to do next is I'm going to share with you when to use the master lease. Let's do that next. Every successful commercial real estate investor has a mentor. Get mentored by me and my team by applying to be our next protege. Click the top corner. Here's when you should use a master lease, all right? I'll give you four scenarios. There's more, but here's just the top four, I believe, okay? So when to use the master lease. Number one is when the seller is tired or he's burnt out, okay? He wants to sell, but guess what? He wants to maintain some income. So you're talking to the seller and he goes, yeah, Peter, I do want to sell, but you know what? I'm old, I'm up there in age, and this property, provides me income every month, but I do need to sell. I can't go on forever, right? And so he wants to sell, but he wants to maintain some income. That's a sign for master lease because we can give him a down payment and then monthly payments while we take control of the property, okay? Right after this, I'm going to give you a quick example how that works. Number two, the seller does not want to pay all capital gains taxes up front. Okay, the seller tells you, Peter, I do want to sell, but I don't want to pay capital gains taxes. That's an open door for a master lease agreement. Okay. Number three, the seller's property is not bankable. Okay, this happens a lot when you go direct to seller, meaning not bankable means he probably has lots of vacancies. He has lots of repairs needed. In both cases, the lender is going to say no. And a lot of times this is interesting, the sellers have no financial documentation. Okay, when you go direct, you will discover a lot of them are like that. And so in those three instances, it's very difficult, if not impossible, to get a good bank loan. Okay, so you're going to have to do a master lease. All right. Number four, seller's personal circumstances require a sale, such as the seller being in poor health, can't go on anymore. uh, the seller may have bad finances, right? Something's going on with them where this property needs to just go away for now, and not even a condition to sell. Has potential, but I can't sell it right now, make a profit, so I'll do seller financing. Bad property management, right? That happens a lot. So a property manager can take down your property and destroy it financially, and then you can't sell it for a profit. So you would sell it on a master lease, like to us. We would fix up the property and pay you off later. Or let's say the seller is going to relocate. Okay, so and etc. So there's more these circumstances I can go over, but these are some of them that you should pay attention to. Now, here's an important note. All four of these reasons are why getting seller motivation is so crucial, so important, because you would take what you learn about these sellers and you would reverse engineer it back into the deal terms. Okay, so again, you get the seller's motivations and we design or we structure the seller, we structure the deal around the seller's motivations. Got it? Okay, next, let me give you a quick example so we can wrap this up. All right, here we are at the last piece. What I want to do here is share with you a master lease agreement example. So if you are working on a deal or considering a deal and you want to know if it fits within the seller is motivated and may fit into a master lease, here's how you do the numbers, okay? And I'll keep the deal really basic, really simple. I am going to use the same 8 unit we used a few minutes ago. Okay, so here's a master lease offer that I made to the seller that was accepted. So I offered him $1 million for the 8 units, and here's my offer. Okay, and this is our default. So our company is known for this. So inside our company, everybody knows what the 1055 is. Okay, 1055 is our default terms for seller financing, especially a master lease. And what it is, it's 10% down, okay, 5% interest only payments, and the term is for 5 years, okay? 10, 5, 5. Got it? Okay, so let's do some quick math here on the mortgage. So $1 million, you're putting down 10%. The mortgage is going to be $900,000, okay? At 5% interest only, it comes out to be $3,750 a month times 12 is $45,000 per year. Okay, so now I have the mortgage payment figured out. Let's do the rest. Okay, so if you recall, this 8 unit had the gross rental income of $116,000 a year. I'm going to estimate expenses to be about 40% of this 116,000. Okay, kind of the industry average. It's about $46,000. Okay, so income minus expenses equals your NOI of 70,000. From the NOI, I subtracted the mortgage of 45,000 right here, and it gives me my cash flow of $25,000. Okay, you got it? Okay, income minus expenses minus the mortgage equals the cash flow. Now, the wonderful thing about master lease agreements is they can produce high cash on cash returns because of the lower down payment request. Remember, the down payment is only 10% as opposed to going to a bank where it's 25 or 30. Okay, so the cash on cash here is 25%. Okay, how I calculate the cash on cash is basically my cash flow divided by my annual cash flow divided by my down payment. That comes out to be 25%. Now, if you want to have a target for your cash on cash target for master lease agreements, for us, it is 10%. So if you cannot produce a 10% cash on cash using a master lease, using these terms, your deal is not good enough. Okay, it really isn't. So that means a lot of deals are not going to fit under this master lease. Okay, so we must have at least a 10% cash on cash return using these terms, or we pass on it. Okay, it's not good enough. Got it? All right, so there you go. There you have it. There's how you do a master lease agreement deal, how to put it all together once you get the seller motivation. Got it? All right. So, ladies and gentlemen, I just shared with you two ways. If you are stuck in your single family homes, you want to scale up with multifamily. If you have been laid off or you don't want to go back to work, or your personal DTI is too high and banks won't let you get a loan, I share with you two ways: the multifamily DSCR loan and just creative financing. So no more excuses. So let's get to work, okay? So if you enjoyed this video and you are still watching me here, guess what? You are my favorite. Thank you for hanging out with me for so long. If you do me a favor, go ahead and like this video. That'll help us out a lot. If you want to get more videos like this, go ahead and click subscribe, and we'll send them to you on a periodic basis. Or if you just want to read a book, if you just want to get started reading a book, the book link will appear so you can download the book and get at it. Or if you want to be like one of our students who made it big, go ahead and the link will appear to get interviewed to be a mentee of ours. Thank you everyone so much. I appreciate you so much, and I'll see you at the next video. And remember, the best time to have bought real estate is always 5 years ago. The next best time is today. I'm Peter Harris. Thank you for watching.